In 2026, a new wave of financial anxiety is spreading across the United States. The headlines are not yet calling it a collapse, but whispers of instability are growing louder. Investors are watching bank stocks carefully. Depositors are asking uncomfortable questions. Analysts are comparing today's warning signs with the early signals that appeared before previous financial crises. The central question being asked across Wall Street and Main Street is simple but deeply unsettling. Are American banks in trouble again? The American banking system is often described as one of the strongest and most regulated in the world. After the 2008 financial crisis, sweeping reforms were introduced to increase capital requirements, strengthen stress testing, and improve oversight. Large banks were required to hold more reserves. Risk models were adjusted. Regulators promised that the mistakes of the past would not be repeated. For years, confidence returned. Major institutions reported record profits. Digital banking expanded rapidly. The stock market surged. But beneath the surface, structural vulnerabilities slowly began to form once again. The roots of the 2026 banking concerns can be traced back to the post-pandemic economic environment. During the crisis period, the Federal Reserve lowered interest rates to near zero and injected massive liquidity into the system. Trillions of dollars flowed into financial markets, businesses, and households. Cheap borrowing fueled rapid growth in housing technology startups and speculative investments. Banks accumulated large amounts of government bonds during this low-rate era. At the time, these bonds were considered safe, stable assets. But when inflation surged in the following years, the Federal Reserve responded with aggressive interest rate hikes. As rates climbed, the value of previously issued low-interest bonds fell sharply. This created a hidden problem on bank balance sheets. While many institutions classified these bonds as held to maturity, meaning they did not need to mark them to market immediately, the unrealized losses were enormous. If forced to sell those assets to meet withdrawals, banks could face severe capital strain. The situation became more fragile as deposit behavior changed. In a high-interest rate environment, customers began moving funds from traditional bank accounts into higher-yielding money market funds and treasury securities. This shift reduced the stable deposit base many regional banks relied upon. At the same time, commercial real estate markets started showing stress. Office buildings in major cities experienced rising vacancy rates as remote and hybrid work remained common. Property values declined. Loans tied to these properties became riskier. Regional banks in particular hold significant exposure to commercial real estate. If property owners default on loans, banks could face rising non-performing assets. This risk has become one of the central concerns in 2026 financial discussions. Unlike 2008, the threat today is not primarily subprime residential mortgages. It is a combination of interest rate shock, asset devaluation, and structural changes in commercial property demand. Another factor adding pressure is consumer debt. Credit card balances have reached record highs. Auto loan delinquencies are rising in certain income segments. While overall employment remains relatively stable, wage growth has not always kept pace with inflation in essential goods such as housing, insurance, and healthcare. If unemployment were to increase even modestly, delinquency rates could rise, further impacting bank earnings. Despite these risks, major financial institutions argue that the system remains resilient. Stress tests conducted by regulators indicate that large banks hold substantial capital buffers. Liquidity coverage ratios are higher than pre-2008 levels. The Federal Reserve maintains emergency lending facilities designed to prevent panic-driven bank runs. However, confidence is a power force in banking. Banks operate on fractional reserve principles, meaning they do not keep all deposits in physical cash. If depositors lose trust and rush to withdraw funds, even healthy institutions can face liquidity crises. In recent years, digital banking has changed the speed of financial panic. What once required standing in line outside a branch can now happen instantly through mobile apps. Billions of dollars can leave an institution within hours. This new reality makes confidence management more critical than ever. Social media also amplifies fear. A single viral post questioning a bank's stability can trigger market volatility. Rumors spread faster than official statements. Financial stability in 2026 depends not only on balance sheets, but on information control and transparent communication. Global conditions further complicate the picture. International economic slowdown reduces corporate profits and export demand. Geopolitical tensions disrupt supply chains. Currency volatility affects multinational balance sheets. American banks operate in a globally interconnected system, meaning external shocks can transmit quickly across borders. Interest rate policy remains central to the outlook. If inflation persists, the Federal Reserve may be forced to maintain higher rates for longer. This would continue pressuring bond valuations and commercial property markets. On the other hand, if economic growth slows significantly, the Fed could pivot toward rate cuts. While cuts may relieve some stress, they could also signal deeper economic trouble ahead. Investors are divided. Some believe 2026 fears are overstated, pointing to strong capital ratios, diversified revenue streams, and regulatory oversight. Others warn that complacency often precedes crisis. Financial history shows that vulnerabilities accumulate quietly before becoming visible. Small and mid-sized regional banks face unique challenges. Unlike massive national institutions, they may lack diversified income sources or global operations. They often depend heavily on local commercial lending. If regional economies weaken, these banks could experience concentrated losses. Mergers and acquisitions are already increasing within the sector. Stronger banks are absorbing weaker ones in strategic consolidations. While this stabilizes the system, it also reduces competition and raises concerns about market concentration. For ordinary Americans, the fear of a banking crisis is deeply personal. People remember 2008. They remember foreclosures, job losses, and market crashes. Even the possibility of instability triggers anxiety about savings, retirement accounts, and future security. Savings, retirement accounts, and future security. The federal government guarantees deposits up to a certain limit, providing reassurance to most households. Yet large corporate accounts and wealthy individuals often exceed insured thresholds. Their rapid withdrawal decisions can accelerate instability. Technology introduces another layer of complexity. Fintech companies and decentralized finance platforms compete with traditional banks. While innovation improves efficiency, it also fragments the financial ecosystem. Regulators must adapt quickly to supervise emerging risks without stifling growth. As 2026 unfolds, policymakers face a delicate balancing act. They must contain inflation, support growth, maintain financial stability, and preserve public trust simultaneously. Missteps in communication or policy timing could amplify uncertainty. The central question remains open. Are American banks truly in danger, or is the system experiencing a painful but manageable adjustment to higher interest rates and economic normalization? Financial crises rarely announce themselves clearly in advance. Warning signs appear ambiguous. Data sends mixed signals. Optimists and pessimists both present compelling arguments. Only with hindsight do patterns become obvious. What makes 2026 different from previous eras is the speed of change. Digital withdrawals, instant information flow, global capital mobility, and political polarization create an environment where stability can shift rapidly. Yet it is equally true that the American banking system has demonstrated resilience before. Reforms implemented over the past decade were specifically designed to prevent systemic collapse. Whether those safeguards are sufficient under current conditions remains the defining question of this moment. If confidence holds, the system may navigate through turbulence and emerge stronger. If confidence cracks even slightly, the consequences could extend beyond banks into housing markets, stock exchanges, employment levels, and global trade. The story of 2026 is still being written. Markets are watching, regulators are preparing, and depositors are listening carefully for signals. The coming months will reveal whether this period becomes a minor financial scare or the beginning of a larger transformation in American banking.